80% of traders are still trading the 2026 market with risk rules built for a calmer world. That is exactly where the problem begins, because now it is no longer just the direction of the market that matters. The cost of being wrong has changed too. Your analysis might be right, but you can still lose money simply because of spread, slippage, or holding a trade during the wrong hours. That means risk management is no longer just about what percentage should I risk. The rules of the game themselves have changed. The first thing that has changed is spread. In markets dealing with energy shocks, war, and headline-driven volatility, spread is no longer a small detail. It has become part of the trade's risk itself. When oil jumps up and down on a Middle East headline and the dollar keeps shifting between risk-off flows and higher rate expectations, there are many moments when a good entry on paper turns to an expensive entry in practice. If you are still entering with the old mindset that the market will make up for it later, you're probably paying a cost that was not this heavy before. The second issue is slippage. A lot of traders used to think slippage only mattered during major news events. But in 2026, when the market is dealing with high oil, uncertain rates, and geopolitical tension, slippage is not just a problem at the exact moment of the news. It is a problem during thin and disorderly moments in the market. That means your stop may not get executed where you placed it, not because your analysis was bad, but because the market did not have enough depth that moment. That difference matters a lot because the trader still thinks they're working with a 1-hour stop, while in reality, their risk was larger than what they had calculated. The third issue is how the market behaves after the news. In 2026, it is no longer just the news itself that is dangerous. The second and third market reactions are even more dangerous. When Federal Reserve officials talk about persistent inflation caused by oil shocks, while at the same time, the market is still caught between fear of slowing growth and fear of higher rates, the first move is often misleading. You make a decision based on the first candle, while the market is only building its real narrative minutes or even hours later. That is why news risk in 2026 is not just about before and after the release. The real risk is in a market that can change its narrative very quickly. The fourth issue is position size. In a market where oil shocks, rates, and the dollar keep shifting phases, position size is no longer determined only by your confidence or how clean the setup looks. Now, position sizing also has to reflect the market conditions. If you know you are heading into a news-heavy environment, a rate-sensitive session, or regional tension, then your usual size may no longer make sense. The mistake many traders make is entering the same market with the same size they always use, even though the volatility range and the cost of being wrong have both increased. In 2026, a good position size is not the size that gives you the biggest profit, it is the size that keeps you alive when the market starts behaving abnormally. And the fifth issue is holding trades during high-risk hours. Before, you could sometimes say that if your analysis was good, you should just let the trade do its job. Not anymore. Because some hours, especially around US data releases, key market opens, or moments when Middle East tensions move oil prices again, the market takes on a completely different quality. If you ignore that shift in market quality and keep the trade open the same way, then you are accepting a new kind of risk that has nothing to do with the direction of your analysis. In fact, part of risk management in 2026 is knowing when even holding a good trade can turn into a bad decision. Conclusion. So risk management in 2026 is no longer what it used to be, because the market itself not longer what it used to be. Spread matters more, slippage is more real, post-news reactions are more complex, position sizing has to be more flexible, and holding a trade during high-risk hours is no longer a neutral decision. If you do not take these 5 things seriously, you may be right on the analysis many times and still end up with results that look like someone who never understood risk in the first place. Now tell me this, in the 2026 market, which one has hurt you the most? Spread, slippage, post-news behavior, position size, or holding a trade during the wrong hours?